Welcome back to another EUVC episode. Today, we continue our focus on how we can finance and drive systemic sustainable transitions. Only 2 weeks have passed since Building Bridges 2025, and the conversation from Geneva are already shaping real actions across the ecosystem. Today, Enrique said, let's bring on Patrick Odier, chairman of Building Bridges. Patrick has been leading the voice in redefining finance's role in the transition, moving from exclusion and risk management to investing in opportunity and system redesign. Under his guidance, Lombard Odier has advanced the wild to click framework, reframing the economy's shift from wasteful, idle, lopsided, and dirty to circular, lean, inclusive, and clean. So with that said, today's discussion is going to center entirely on how investors can finance the shift, and not just as philanthropy, but actually as a model of value creation and competitiveness. Welcome to the podcast, both of you. Before we start the show, a quick note. If you're building or running a fund, you know it takes the right partners. At EUVC, we only work with sponsors we truly believe should be part of your tech stack. Please do take a moment to hear about them. And if you do, reach out, mention EUVC. It's the best way you can support what we do. Thank you so much. Starting off, HSBC's innovation banking. If you're a founder, a scale-up, or a VC, you need a bank that actually understands your world. HSBC Innovation Banking backs innovation globally, from seed to IPO. And if you ask me, a strong banking partner like HSBC belongs in your stack. If your portfolio companies are scaling, they need infrastructure that won't slow them down. Google Cloud Starter Program offers $2,000 to $350,000 in credits, plus technical support to build better and faster. It's a key boost every fund should bring into their ecosystem, and oh my God, are we thankful to be partnering with them. Now, legal is a space you cannot lag on. Legal needs to move at the speed of venture. Goodwin's team has decades of experience with startups and funds. They're trusted at every stage from formation to exit. Goodwin definitely is a legal partner every serious manager should have in their stack. For Luxembourg-based VC, PE, and fund-of-fund managers, modern funds means going digital. Fundcraft gives you a full-service, digital native platform built for today's European managers. It's a must-have if you're scaling smart. So we all hear about the Middle East. How about you go there? From AI to deep tech to sovereign fund, Skytex in Dubai is where global future of tech gets negotiated. It's not just a conference, it's where East meets West, capital meets innovation, and the bold set the agenda. If you're playing on the global stage, join us going to Skytex this year. If you're gearing up for your next fundraise and want a placement agent who truly understands emerging managers, reach out to C Funds. They're a boutique placement agency that has helped GPs across Europe raise capital from top-tier LPs. We've been on the other side of the table here. They are actually good ones to work with. So I do urge you to go to cfunds.io to go and check them out. And hey, before you go, if you're looking to discover startups, raise capital, connect with innovation leaders, do check out dealflow.eu, the EU-backed platform bridging founders, VCs, and corporates. There's no better place to find the startups that have received significant funding from the European innovation ecosystem.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.
This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
Thank you very much, Andreas. It's always a pleasure to speak to you about circularity and the people that we believe that are actually making that shift from a linear perspective to something that has a more long-term vision in terms of the development of products and services, especially in finance in this case. I think that there is no one better than Patrick that can tell us what is that transition in finance and how actually Building Bridges is becoming the soul of this attractiveness for financial people and impact people, and the agenda of circularity is part of it. So I was super happy when he accepted to be with us to really deconstruct a little bit and see how the different financial companies and also institutions are actually engaging with this discussion through the Building Bridges and through their agendas. So Patrick, I don't know, maybe it's after the different editions, what have you seen that is moving in terms of circularity and especially in the Building Bridges?
Well, thank you very much for having me today. It's a pleasure to be discussing these issues, especially after the 6th edition of Building Bridges. The red thread, if you wish, is that while there's been a number of headwinds about sustainability in general and sustainable finance in particular, linked to many things that all your audience knows about. There is a definite train on the track with regard to the transition of the real economy. And I think if it is the case, it is of course of utmost importance that the financial sector continues to follow very narrowly what's happening in this transition. And circularity is one of the pillars of the transition. Calling circularity as it should be, it's basically a business reason to do things differently, a business reason that is driven both by cost consideration, and in particular with regard to the ratio input-outputs, but also by risk consideration with regard to, of course, the way resources are being extracted, exploited, and wasted at the end of the cycle, which could create, in terms of risk, a number of not only physical, but also legal and perhaps reputational risks. So I think circularity is, and if you took the examples through which, for instance, Lombard went through, circularity is one of the probably 2 or 3 most interesting areas to look at from an investment perspective. The other ones being perhaps the transformation and electrification of the industry, transformation of the energy sector and electrification of the industries in general. The second, it could be perhaps the major system change that have to happen in the nature space and the related space. The third one has probably to do, before even calling that circularity, with the materials and the way those materials are basically extracted, exploited, and reutilized or not. And I think in this respect, there is a universe of investment opportunities that is extremely wide and has increased along the years because of new technologies and because also of partnerships between the financial sector and the real industry itself. That's why I think, looking at circularity as an investment space, as an investment universe is so interesting today. It is not very different from the rest of the sustainability universes that one can look at in terms of investor. Sustainable investing has only one reason to be, which is to achieve excess or at least market risk-adjusted returns. And from an industry point of view, to make sure that the economic model is adjusted to the risk I just described. It belongs to the general responsibility of the investor to look at circularity as one of the most interesting universe, simply because not looking at it would make us miss a number of interesting opportunities and also mismanage a number of potential big risks.
Could you, and we should dive into everything you just said more deeply. Could you, before we go there, just describe your own journey coming to where you are today, and when on your journey did you realize that the importance of sustainability could no longer be overlooked?
Yes, well, I think that, first of all, we all start by being citizen of this world, and we all observe a number of changes, trends that do affect our daily lives, whether it's as citizen and whether it's as businessmen. I think we owe it to our stakeholders to do it, or to our family to do it. If you look at my particular experience, I've been in the business for a number of decades of investing for the benefit of our clients and investors, families, entrepreneurs, institutions, etc. So I really felt that my and our fiduciary responsibility was precisely to make sure we don't miss such trends as the one I'm just mentioning. When we started looking at sustainability, it was really for the reason of hearing from the investors community that there were a number of concerns about how business models were developing that would probably have an impact on how investors will allocate capital. This allocation of capital could lead to a number of different consequences, one of them being the cost of capital. And that's why, as a fiduciary, looking at some investment opportunities 2, 3, 4 decades, even perhaps not 4, but at least 3 decades ago, we started going to our investee companies and asking them questions about their sustainable strategies, because we felt that some of them could lead precisely to perhaps debates with the investors community, and hence to different types of allocation decisions, different from the ones at least that they would expect. That was the first step. At the time, we were talking about trying to exclude certain areas of investment, This was the years of the 90s, trying to have industries described as being non-investable for more ethical or responsible reasons. Then we moved into I would say other models of looking at sustainability, and in this respect, best in class was probably the approach that the industry did adopt, looking at different sectors, the 160, 70 sectors, industrial sectors in the world, and trying to decide what basically was acceptable from a risk-adjusted return point of view, but also perhaps from time to time an ethical or other reason. That led little by little by the definitions of more standards being available in order to drive this sustainable trend, at least from the financial sector, into the right direction. We participated in establishing those standards, which basically had to do with defining what were the criteria to accept or not accept that a company would behave in a sustainable or not sustainable way, and to construct portfolio with those that we felt were more sustainable. And there I should make a little parenthesis. Why at all look at only companies that would respect some sustainable criteria? Well, this was probably done, and probably at this stage, done through the review of our global macroeconomic model. Looking at the global macroeconomic model is, of course, the essential basis on which any investment decision should be made. And looking at this macro model led us quickly to define the limits of certain of the trends that the macro model was offering. And these limits translated into different types of concepts. One of them, for instance, was the planetary limits that everyone is talking about, which we've breached out of 9, 7 of them being now at least, if not breached, on the verge of being breached, meaning that the way the economic model globally seen as a firm appeared to us as being implying a number of big risks, including an existential risk for the planet and for its inhabitants, but also a number of risks with regard to the economics of some of the investee companies. And that's when, little by little, the approach has specialized into an approach that, instead of trying to qualify an investment as being sustainable or not, green or brown, we decided to look at how would certain types of investments contribute positively or negatively to the reaching of these limits that I was just alluding to. And of course, try to favor in our portfolios the companies, and I will come to the asset classes, in try to favor companies that were in their own sector standing out in terms of avoiding some of the big risks that others were taking by not adjusting their business model. So in terms of how to do, or in tools on how to do that, take, for instance, the COP21 2015 types of decision to set a metrics for measuring the dangers with respect to reaching climate limits, the 1.5 to 2 degrees Celsius not to be exceeded by the end of the century. If you look at this very element, this has been tremendously helpful. For instance, for those investors that were interested in climate protection investments, or at least in mitigating some of the climate risks that were identified. Why? Because we could, through some methodologies that were widely encouraged by Mark Carney and his team at the time, and the TNFD team, a portfolio implementation team, we could define methodologies, for instance, describing how a company can contribute to the elevation or the reduction of the temperature on the planet by its activities and or by its business model. Choosing the ones that were contributing to reducing the temperature of the planet was probably the bet that would be taken by those who had a sensitivity with regard to sustainability, because these would be the one winning ultimately, both in terms of avoiding risk, in terms of surviving, in terms of attracting talents, in terms of avoiding liabilities and or legal difficulties. And I think this was basically the time where, coming back to your question, where moving from those best-in-class and other types of approaches, we really resolutely and with determination started to look at basically the transition of the business models in whatever sector we had an interest. and this across asset class. So that's a bit the story that led us where we are today, and that's why we're not describing investment universes as being investment universes that are sustainable or not sustainable. We're saying if a business has to be successful, it is because it's going to be sustainable. And if an investment decision has to be successful, is that because choosing business models that are sustainable will bring additional returns.
And this, of course, impacts, as an example, if we take big oil as the boogeyman that we all have been used to in the impact frameworks as not liking. If you're doing good transition work and you're being sustainable and thoughtful in how you're producing the value you are as a big oil company, then it still makes sense. And it allows you to invest, I expect, across every sector, not label anything as something you cannot do, but rather you say, within this field, we invest in the companies that are on the right trajectory, that are taking the right steps, that are moving in the right way. Is that correctly understood?
Yes, Andreas, you're spot on. That's exactly it. That's why there's no sector per definition. There are rare sectors where you could, for business policy reason, avoid investing, of course. But if you look at the sustainability filter, the oil industry example is a good one, actually, because we know that we are in an energy sector transition. We know why, and we know where we go, because technologies have led us today to have other means to produce electricity, which is highly needed for all the reasons we know, than extracting oil. And I think in this respect, what is interesting is to see if part of the sector that is today fossil-driven will adjust its business model with its experience of producing energy, services and or products for the benefit of the more renewable energies. There's no genius idea in the concept of saying those who have been in energy producing yesterday, according to yesterday's models, are probably the best position to adapt to produce energy tomorrow with the right new tools and technologies. And that's why there's been this debate or excluding or not excluding oil investments in some of the more sustainable portfolios. And I've always been saying, we're going to correct what has to be corrected probably much more effectively by investing in some of the hard-to-abate sectors and trying to convince them to adjust their business model by way of investing or allocating capital more or less, depending on their decision. Then we were going to do it by excluding from our portfolio what will probably be taken very easily by another portfolio. So I think this is the answer to your question. Indeed, we're looking at all sectors that don't exclude, with rare exceptions that are probably more of a moral reason, some sectors that we feel should not belong to any investment portfolio.
Very curious to hear then, because you said we're going to get to asset classes. And I think that's the natural next big step, because one of the things I tend to say is, well, I love tech because it's almost whatever you do in tech or in venture, you're probably advancing the world to a better place. Then some would say sometimes we get it wrong and create a Facebook, and other companies that many today are saying, well, maybe we should have had more guardrails from the beginning. But as a whole, I think that we can conclude that venture is actually a good asset class for the world. But I do feel that sometimes I get headwinds when I say that to impact people, because many say that, well, I actually think that we've done many wrong things in venture as well. I love if you would look at because this will also, we have a big GP audience, so VC audience, that to whom I think it is awesome to hear from someone with your vantage point. How would you describe venture in the set of asset classes? Because it is important armament when talking to limited partners, of course.
Yes, it was a pleasure. And in all humility, I mean, there are different approaches. And I think the way I personally see it is that, let me step back one step. First, technology is one of the most important levers of the transition and or transformation we were just discussing. So it happened that the acceleration of the technology developments in the latest decades has been second to none, and of course have led to a number unequal number of new opportunities to transform, transition, call it whatever you want, whatever process you could imagine. And that's why the ability to invest in those technologies by one mean or another has been essential to exploit that lever for the transition. Quickly said, the other levers that could be very effective would be you and I consuming or not consuming certain types of products and services, or it could be the regulator telling you that if you continue to do that, you're going to be out of business. But I think that in general, capital is one of the fundamental reason why, things may change, because our world, our industries are in the need of more funding and capital in general to exploit all those good ideas, including those tech ideas that are emerging. That's where today, if you take the different asset classes through which this sustainability lens can be applied as investors, I think the venture class is probably a very interesting one, because it takes the initial risks to create the wider universe in the short and medium term. And I think that's, of course, always, whether it's from a global and multilateral institutional point of view, or whether it's from a private investor's point of view, or a big pension fund point of view, it's always this notion of mitigating risks that will make the difference in these transformative types of investment opportunities. And venture capital is here, of course, of the essence, because venture capital, by definition, is willing to take some of that risk. So that's why I personally think that perhaps widening a little bit the issue outside of venture capital, I think the private asset market, asset class in general, is probably one of the most interesting asset class to be exploited by investors, not only for sustainability reasons, but in particular also for sustainability reasons, and within which, of course, venture plays a key role, which is precisely to somehow mitigate that initial risk period that needs to be mitigated in order to unlock massive capital into those ideas and solutions.
For the audience, and we have a bunch of impact investors, of course. So could you maybe just talk a bit about how you, either personally or with the Building Bridges or with the Lombard Odier lens, look at impact as a sub-asset class within venture, or maybe even impact more broadly? Like, because as an example, there's a big discussion about how returns driven is an impact investor. Where do you fall on that lens? Is it important that you're first and foremost returns and then after that impact, or is it the other way around? And say a bit about where you think that it's wise that managers fall on that spectrum.
Yeah, if you distinguish philanthropic capital from investors' capital or investment capital in general, I think one, willingly or not, has to recognize that the return expectations are a sine qua non, a condition to an investment. And the particularly good news of the times of today is that these returns expectations do not contradict impact expectations anymore. I.e., there was a time where impact had to do probably more with philanthropic types of activities, narrowly defined projects in emerging or new frontier markets that were hard to be reached by the mainstream investors, both for regulatory and for information purposes, perhaps also liquidity issues. Today, the notion of impact has come to be embedded in probably many more portfolio decisions than it was in the past. I wouldn't say it's completely mainstream now, because it's, frankly speaking, not. And Building Bridges is trying through its convening power to make sure all the stakeholders around the table can see at what condition could impact be embedded in practically all of the decisions that have to do with investing. But we're not completely there. Let's recognize it. And one of the reasons why impact is not completely embedded, it's because impact is simply difficult to measure. And why is it difficult to measure? Because there's no single common impact measurement across sectors, for instance. So I think one of the interesting current developments that I can see and sense around our stakeholders community, particularly at Building Bridges today, and particularly in the academic circle, is a lot of research is being done in trying to create a toolkit that allows now comparability between sectors when it comes to measuring impact. And, we owe it to the community of investors, retail clients also, when it comes to other than venture capital, of course, solutions. We owe it to our investors community, globally speaking, to put some order in this universe of impact investment that remains particularly attractive. So impact is, I think, today much more part of the decision, but is not to be opposed to return. I think it comes with return. And of course, the aim is to have a triangular approach to an investment decision that will go through a risk, impact, and performance, but not sacrificing one against the other.
I would like to give our audience a perspective on these opportunities of investments, right? Like, so we are saying that we have these technologies that are always emerging, and they are a way to find solutions to challenges. But then there is a specific investable solutions like energy systems that we were discussing before to decarbonize and storage and distribute energy in different ways. The food and agriculture, also with the regenerative models, the soil health, the agri-tech, multi different ways to support and develop food production and food waste, and materials, right? Like materials as plastics that can be used in a more circular way, designed in a more circular way, reuse models that advance the way we are consuming and make this loop between the consumers and the producers a more engaged structure that we are all part of it.
If you take the materials, which is probably the better approach to this also circularity issue, we are absolutely convinced of a few basic elements. One of them being that there are materials that we don't like because they are creating lots of collateral damages, especially in the growing economic model, such as cement, such as plastic, such as steel, aluminum. We know that these materials will continue to be highly useful to ensure stable and continuing growth, and until further notice that they have no replacement, and technology has not yet successfully been in a position to replace these materials, including, if you take plastic for the most vital needs, which have to do with some of the medtech instrumentation that we're using to live longer. And I think in this respect, that should lead us to think about what could we do better than simply observe that these materials that are creating huge damage to the planet and nature in general, why could we do otherwise to make sure that we handle this necessity to continue to produce with them in a better way? And I think there we clearly set ourselves in plastic, for instance, the objective to reduce the plastic waste, which is an impact measurement which is possible to size, I think, in a not too complicated way. And if you take that impact, which has to do with how can you minimize plastic waste, I think you can attach it to target returns that make it a great investment area. Why? Because there are many solutions that are today possible through some new technologies to either lower carbon for the plastic value chain, or to use mechanisms that help us to perhaps avoid too quick utilization or wearing out of those plastics. Think about refill models of repair industries and chain of productions. Think about reusing models for plastic-made types of products. Then there's also a huge value chain part which has to do with recycling those materials and creating new products out of old one, etc., etc. So I think, in general, some of these areas that are linked to materials do offer, by different type of segments, a wide universe of new opportunities that technology allows us to consider. And I think that's why, for instance, in plastic, we have seen, and that was particularly the case with actually the Lombard approach, we've seen an interest in talking with the industry, which is the best position to tell us what could be done and what could not be done. In other words, trying to team up with those producers of plastic materials in order to try to identify both for their interest and our interest as investors. What could be the solutions either in this part of, better using the plastic as today and trying to avoid too much extraction, or to recycle by sorting properly first and then recycling correctly second the materials. In this respect, this is an investment universe that was barely visible 10 years ago. This is something that is quite new, and it's becoming the case in other materials. So that's why I think plastic is highly interesting. Perhaps there was too much enthusiasm too quickly, because as we saw, ending plastic waste is, from a political point of view, very difficult. We cannot get to those international agreements on how to do that as quickly as we should, despite all the efforts by the United Nations and others. But at the same time, nobody said that industry has always waited for those international treaties to find innovation and try to finance innovation. So I think that's why I personally think this is a particularly interesting, both for venture capital, the private equity, but also for listed solutions investment universe.
I got to ask you a question. And I know that there is a lot of important things that we should also touch on, especially on the back of Building Bridges 2025. But you also put the context of the conference, you put it quite well. You said, in a time of growing geopolitical complexity and public debate around ESG, Building Bridges is proud to convene a summit focused on the topics that we're talking about here, to bring clarity, courage, and ambition to the forefront of sustainable finance. Like, that is spot on. And I got to ask you about the first part of that sentence, the geopolitical complexity and public debate. I have asked on every single podcast I have done on this topic of impact, I've asked specifically around this, like, what's the market like? What does it feel like? But every time it's been with VCs, and VCs have a very clear agenda, of course, to say, it's all like, we figured it out now. We know the importance of being focused on the value proposition and like not oversell the narrative, understanding there's not a green premium and all these things. But you come from a very privileged position, I think, to be able to say what is actually being discussed in the most important boardrooms and hallways when it comes to this topic. So, because we are, of course, all seeing what's happening in the US and the push that's coming also from the, not just the White House, but also the rest of the governing bodies. I'd love to ask you, like, where do you see us on the timeline here? What's happening? How should people navigate this?
First, I will say that what has been coming from the North American side, and more precisely the US side, has of course not been positive in terms of signaling to the rest of the communities how important are some of those trends that we've just been mentioning, whether in climate, nature, or energy in general. This being said, as you probably know also, while it's a bad signal in general, nobody said that the transition would be linear. And there may be a reason, as we experience in Europe in particular, that make investment allocation or capital allocation change its course for absolute necessary reason. And when you take the energy, it's absolutely the most compelling examples of non-linearity, where everybody is recognizing you should get out of coal, you should stop extracting fossil, and then at the same time you see cheap sources of energy, even cheaper to produce electricity today with photovoltaic as with fossil, but you're not investing enough in there for many reasons, including economic basic reasons, interest rates and the like. This is bad, of course, because we would prefer to have this transition occur quicker for the benefit of society in general. But it is not to say that this will prohibit this transition to reach its targets, especially when we have targets such as when we've set to decarbonize with a horizon of 2050, for instance. So I think we should be very careful not to conclude too quickly about these shorter term types of headwinds, including geopolitical, war times, difficult military pressures, etc. in Europe, and perhaps very politically driven types of comments, America's first and others in the US. I think we should simply recognize that it can happen and continue to look at the fundamental trends. What are those fundamental trends? Well, I mean, you know them as well as I do. We probably peaked in terms of fossil extraction now, and that means that having recognized that the production of electricity and energy in general issued from renewable sources is cheaper will simply make investors and the markets and consumers in general look at those energies with more interest than ever in the future, and probably accelerate some of the investment that are needed to not only produce more of this electricity, but produce this electricity in a better way, and also to stock and of course make sure that this electricity can find its infrastructure to make sure it can be as stable as possible. We know that the world is going in that direction. We know that it cannot be otherwise because economic factors just dictate the priorities and the direction. So I think one should recognize, one, the non-linearity of some of the trends we're trying to set, to encourage and to set. And second, I think that the market forces will be there to make sure that the economics will improve further and probably in that sense accelerate the transition. This being said, in big parts of the world, the headwinds are different. Some are very favorable. Some are favorable. Take Asia in particular. Asia has been showing leadership in some of those venture tech universes that are also extremely interesting, of course, favored by a political system that is probably more favorable in this respect, because once the order was given, of course, execution followed, whereas with our systems in general, it's not that easy first to make the order and then suddenly also to make sure it's been enforced. So I think it will be differentiated across region, but I think in general, these trends are really happening. And I don't think that the headwinds should be reasons to think that we will return to a point of considering that sustainability is not necessarily a serious objective and a necessity. I think the world has recognized it. And it's true in every industry. I mean, go to any boardroom today. I can tell you that I haven't met in the last at least 10 years that I've been particularly in the center of those conference organizations and discussions and debates and policy discussion. I haven't barely seen any boardroom member that was not trying to ask better questions with regard to what's the importance of the sustainability criteria for our business model.
I'm going to add to that the fact that is also coming from the bottom up and the students that are going to be the next leaders of the future. I was last week at the IMD in the course of sustainability from Julia Binder. All the students have recognized the importance of sustainability in their way of thinking. And it was a very interesting session where they were presenting their ideas on a sustainable business model coming from their personal background, their personal needs, their family, society, different countries, and really all merge into action. And these are people that are studying on a high level education to get to those positions where they will be leading. And it's really interesting to see how committed they are in building stuff that is actually more connected to our needs, to our planet boundaries, to our society, to the circularity aspect. It's really a pleasure to see that. And it gives you a lot more of enthusiasm and also, I would say that collaboration in the end, because you see that is happening despite the fact of macroeconomical challenges that we are facing and that eventually will move ahead and there's going to be other leaders that will take the role. But society in different levels is recognizing that this sustainability is coming to change the way we are doing business.
Yes, no, but I'm happy to hear you, and I count on the young generation. This being said, we should not underestimate the existing generation. Of course, it's, I represent even the past generation in some respect, but I think we, for instance, at Lombard, we made that turn. I mean, we completely made a turn to make sure that our commitments to sustainability was founded on a well-structured professional analysis of where our macro view should be and what did that macro view entail in terms of selecting the sectors and the type of companies that should be invested in. And I think for all asset classes, and including VC and including private capital, private equity in general. Perhaps let me just make a bridge between what you just said, and this area of circularity that was at the beginning of the subject at the beginning of our conversation. If you take the plastic, we have teamed up with an alliance to end plastic waste, which is basically a group of 70 of the largest producers of plastic in the world, having industrial experience in producing what is one of the most damages for the planet type of product, and hence having also the probably incentive and expertise to identify with us the feasibility of new technologies and perhaps new solutions with regard to producing, recycling, sorting, and using plastic in general. This is the way we've done it. Why would there be an alliance of the 70 biggest producers of plastic in the world, including, the bottle makers and or the food industry? Well, first of all, there's a strong element in this trend, and this is not to minimize what you're saying about the consciousness of the younger generation, but there's also a strong element of policy and regulation taking places. Huge element of policy regulation. And I think in this respect, we may like it or not. I personally think that it is not a matter of the quantity of regulation, it's the matter of the pertinence of the regulation. What is the objective of the regulation makes of the regulations a good or a bad regulation if the objective is a good or a bad one. If you look at what happened in plastic, this is typically an area where, if you wish, today we're seeing increasingly strong pressure from the policy and regulatory framework to try to avoid plastic waste. And if you look even at the tax element, tax on virgin plastic today, I think in Europe, if I'm not mistaken, is about, I think it's close to $8 billion or 8 billion euros per year. This is a huge amount that is increasing every year. And I think this will put a huge pressure on the manufacturer. That's one. If you take the you and I, the buyer's advantage or not, it's also there. Absolutely clear that the current situation makes it for us easier to come down from the post-COVID period, if you wish, and to try to accelerate our use of other types of materials than plastic, but at least to use plastic in a more educated way. That's why, for instance, you don't drink any glass of water with a plastic straw anymore. And I think that this is coming in all products and all markets. Then you have the sheer even market forces in general. As we said before, improving the economics on one end, but also making the economics more transparent. With everything that has been said on the value chain transparency, yes, there are hesitation and simplification that are needed, but at the same time, we are going towards more transparency on the value chain, which will absolutely, that's clear, lead both consumers to make better educated choices, but also the producers to be more attentive to the way they're producing their products. And I think in this respect, it's to avoid the physical risk, it's to avoid everything, but every reason is good. Take the bioplastic market industry, which is also prone to venture capital investment that are quite interesting. Today, it's a huge growing market at over 20% compound annual growth per year. If you take finally the corporate actions, which I was mentioning also before, companies making are today really making commitments. Some of them are being, of course, attacked by local jurisdictions. We spoke about it. But in general, the commitment of the largest consumer brands today in plastic waste reduction are second to none. It's huge. It's a huge amount of tons per year that are committed by the biggest producers of those materials. So I think all this tells you, whether we like it or not, it is happening. Whether messages from the policymakers are coming or not, it is happening, despite the headwinds that we were mentioning before. And that's why I personally think that materials is a hugely interesting area, because it's at the origin of every type of product that we're going to have to live with and perhaps to consume one day, or to reduce consumption of, if you make exception of nature, which is even earlier at the sources of everything what we produce.
Patrick, we could have spoken for hours and hours on this topic. I just, for one, have to say I'm so happy you came on the podcast and spoke from your vantage point, because it's a very unique opportunity for the ecosystem to hear from someone like yourself that has seen it all and really helped pioneer the movement here. To understand, like, in your terms, how do you think about impact? Why do you see impact moving forward in the way that you are sustainable investing? Because I think you put it more clearly, more succinctly here than I've heard many times on the podcast. And I think a lot of people will be very thankful for this session. So I would say on behalf of all of us, thank you so much. Thank you so much for coming on today.
Well, thank you very much for having me.
And Enrique, almost an as big a shout out to you for making sure that we got Patrick on the podcast. What an incredible guest and what an important episode we did today. Thank you, buddy.
Thank you. It's always a pleasure.
Before we start the show, a quick note. If you're building or running a fund, you know it takes the right partners. At EUVC, we only work with sponsors we truly believe should be part of your tech stack. Please do take a moment to hear about them. And if you do, reach out, mention EUVC. It's the best way you can support what we do. Thank you so much. Starting off, HSBC Innovation Banking. If you're a founder, a scale-up, or a VC, you need a bank that actually understands your world. HSBC Innovation Banking backs innovation globally, from seed to IPO. And if you ask me, a strong banking partner like HSBC belongs in your stack. If your portfolio companies are scaling, they need infrastructure that won't slow them down. Google Cloud Starter Program offers $2,000 to $350,000 in credits, plus technical support to build better and faster. It's a key boost every fund should bring into their ecosystem, and oh my God, are we thankful to be partnering with them. Now, legal is a space you cannot lag on. Legal needs to move at the speed of venture. Goodwin's team has decades of experience with startups and funds. They're trusted at every stage from formation to exit. Goodwin definitely is a legal partner every serious manager should have in their stack. For Luxembourg-based VC, PE, and fund-of-fund managers, modern funds means going digital. Fundcraft gives you a full-service, digital native platform built for today's European managers. It's a must-have if you're scaling smart. So we all hear about the Middle East. How about you go there? From AI to deep tech to sovereign fund, Skytech in Dubai is where global future of tech gets negotiated. It's not just a conference, it's where East meets West, capital meets innovation, and the bold set the agenda. If you're playing on the global stage, join us going to Skytech this year. If you're gearing up for your next fundraise and want a placement agent who truly understands emerging managers, reach out to C Funds. They're a boutique placement agency that has helped GPs across Europe raise capital from top-tier LPs. We've been on the other side of the table here. They are actually good ones to work with. So I do urge you to go to cfunds.io to go and check them out. And hey, before you go, if you're looking to discover startups, raise capital, or connect with innovation leaders, do check out dealflow.eu, the EU-backed platform bridging founders, VCs, and corporates. There's no better place to find the startups that have received significant funding from the European innovation ecosystem.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.